final new venture, the American Dream Match Fund, which is our view of a national marketplace for match savings to leverage individual donors and corporate donors to match the savings of low-income people. So why do we focus on assets? We've found over the last 20 years that assets matter. And they matter economically, they matter socially, and they also matter psychologically. We have seen, and we're going to show you a little data to this effect later on in the presentation, that asset poverty rates and wealth gaps are worse than income poverty and distribution. And I think we have never seen the impact of this so dramatically as we have during this current economic and financial crisis. Asset building strategies are key to enhancing household economic stability, educational attainment, and economic mobility. And at the same time, we have seen that historic patterns of public policy has both contributed to asset poverty and to the inequitable distribution of assets along the income lines. Our approach is to advance large-scale, inclusive asset-building policies to help reverse income and wealth inequalities, as well as to make our society more productive. So why does this matter? We have found, as I said earlier, that the distribution of assets is highly unequal. 22.5%, or more than one-fifth of the U.S. population, is asset poor. And this is a very conservative definition, which means that a household does not own enough assets to survive 3 months without a job at the poverty line. I don't know how many of you saw a news report several months ago about in Sacramento, California, where they interviewed the residents of a tent city. Many of these residents had relatively well-paying jobs before they landed here. And several of the people said, after 3 months of losing my job, I was in a tent. And to me, this was a very graphic description of what asset poverty means in this country, not just for very low-income families, but for families who otherwise we would view as middle class. We find that 1 in 3 households with children live in asset poverty, so that's 33% of households with children. 14% of all households and 24% of minority households are extremely asset poor, which means they have either 0 or negative net worth. That means absolutely no reserves on which to rely should any crisis hit this family. For every dollar owned by a household in the top 20% of income, households in the bottom 20% own just 2 cents. For every dollar owned by a white household, a minority household has 16 cents. So how have cities become interested in building assets? In collaboration with Cities for Financial Empowerment, you'll hear about this in much more detail in a little bit, you'll see that many residents live lives of extreme financial vulnerability in cities. And we see asset poverty rates double or even in certain cities triple to those of income poverty, rising all the way up to 58% of households in certain cities. We also find that the percentage of consumers with subprime credit scores range from 41 to 3/4 of the population. And if we think about what is the one entry point into the economy today, it is your credit score. And then the percentage of unbanked residents ranges from 7 to 24%. And we find many residents live in communities and neighborhoods without any credit union or bank branches. There has been a growing interest among cities in providing financial empowerment services, really to complement what we see as more traditional service delivery. And we're going to hear detailed examples of many of the innovative practices among cities. Both Jose and Jonathan will be describing 10 of these cities who form Cities for Financial Empowerment. And we have been privileged to join with Cities for Financial Empowerment to identify and collect really seminal data on what's going on in these cities and document policies and programs that are helping to change the lives of city residents. We have a long history as well as working at the state level. And in September 2009, we issued our 5th edition of the Assets and Opportunity Scorecard. This is the most comprehensive tool in the country to measure ownership and economic opportunity at the state level. What's critical about the scorecard as it evaluates and benchmarks each state is that it has a framework that connects asset development, asset protection, and key social insurance programs as a means to expand economic opportunity and build assets. And hopefully Jim is going to the website on, for the scorecard, which, if technology allows us, we have 92 outcome and policy measures in 5 issue areas. And these outcome measures describe how families are faring, and the policy measures describe what states can do.
Hi, Andrea. This is Jim Coney. I have it called up, and I'm just going to flash it on the screen right now.
Okay, that would be great. So the place to go is CFED's website, which you'll see is scorecard.cfed.org. And it is an absolutely extraordinary resource where everything you could want is right at your fingertips. I'm just pulling up the web site on New York State, which did not do so well. And I'm preparing for a major presentation there next week. And I want to go down to the asset poverty rate in New York State. And you'll see down there that New York State is 49th in asset poverty, with 32.5% of the residents in New York State living in asset poverty compared to 22.5% in the United States. And what the website allows you to do is it allows you to look at every state according to all measures. It gives you policy ratings on the side. It explains what each one of these measures means. It allows you to compare yourself across, and I'll just highlight at the top the 5 issue areas of businesses and jobs, housing and home ownership, healthcare, education, and then all the way to the left, financial assets and income, with a 6th category called community investment and accountability policies, which is not rated in the same way as the first 5 categories. So, Jim, we can get out of the scorecard now, but I want to encourage all of you to go to the scorecard. We have policy briefs. We have a whole host of resources that look at virtually every aspect along those 5 categories. And with this, we have mounted a national policy campaign now working in over 25 states to really leverage the scorecard on behalf of policy change in all these areas. So our favorite phrase today is the assets movement at its moment, and I had the feeling of the truth of this as I looked at all the people who registered for this webinar. You'll hear later from my colleague Carol Wayman about the significant federal opportunities to build and protect assets. But what we have also found through our initiative called Innovation at CFED is that there is extraordinary richness of ideas and experimentation happening on the ground, with organizations and individuals advancing new products, programs, and policies that are looking at new ways of helping individuals, families, and communities build assets. One of our initiatives is called Innovators in Residence, where I identify people who are already tested promising ideas and are looking to take them to scale. And some of these include linking workforce development with asset building and access to financial services, embedding asset building products into citywide social service programs, and applying behavioral economics insights to product design and delivery in the asset building field. We view innovation at CFPD as a platform to accelerate innovation. And our goal is within the next several years to identify ideas that can expand economic opportunity for 1 million or more low-income Americans. And I have the website there. We won't go there at the moment, but there's a wonderful website and innovation community that you may be interested in joining. So with that, I'm going to end my presentation with my most adorable piggy bank and urge you to put the date of the 2010 Assets Learning Conference on your calendars. This will be the largest convening of asset building representatives in the country, scheduled for September 22nd to 24th in Washington, D.C. Many of you I know joined us at the 2008 conference, where we brought 400 of the conference participants up on the Hill, where they had over 900 collective visits. There was a very strong sentiment among the participants that they wanted to bring this conference back to Washington. And we are integrating our Innovation Summit, which many of you came to, with the Assets Learning Conference in 2010. So we are hoping all of you will bring us great new ideas. So with that, I'd like to hand the reins for this over to my colleagues, Jonathan and Jose.
Thank you, Andrea. This is Jose Cisneros. I know on behalf of Jonathan and myself, we're very excited to be able to join everyone today and talk about cities for financial empowerment. I just want to state that we see a lot of important work happening at the municipal level. And, you know, that's really nothing new. We all, I think, are accustomed to local government reaching out with important messages, whether it's fire and police departments giving us safety messages, health departments telling us important things we should pay attention to keep our families healthy. We see that there's a variety of works that make sense to happen on the local level. What our Cities for Financial Empowerment Coalition does provides a platform for these municipalities to advance that work and both look locally and across other cities to see how we can leverage resources to benefit folks who live in our communities. Our members work together to pursue a number of different programs across our various cities, oftentimes in collaboration with public, private companies, and nonprofit sectors like community groups and foundations. A number of our member cities have made measurable commitments to increase the public awareness around very, very critical issues of financial education and financial stability. We've designed and implemented programs to really help people take better advantage of the resources that they may not even know are available to them. We've also joined together to advocate for policy changes all at both state and all the way up to federal levels. The key strategies that we've rolled out in our coalition and across our cities are these four: improving access to financial services, and that means oftentimes helping even shape some of the products and services that people are able to get to and able to use. Advancing financial education of all different types and forms, encouraging asset building and protection, and as we see as critically important, oftentimes promoting tax time services and providing real help to people when they need it. To describe more about those four areas, I'm going to turn it over to Jonathan.
Thanks, Jose, and I also want to add my thanks to Kennedy School for putting this together. The Cities for Financial Empowerment, as Jose said, have been trying to figure out how to leverage what cities can uniquely bring to the table, and at the same time, we have been very careful to articulate what it is that defines the field of financial empowerment as a subset of the larger anti-poverty work that's happening around the country, so that we can really target those efforts. So turning to the first of those categories we see on the screen here, this question of how does a city use its power and opportunity to advance access to financial services. And as the slide says, we found some very creative ways to do that. And I think that one of the things that's also true about cities is it is our literal public mandate to serve the entire city. And so one of the hallmarks of our efforts is large-scale approaches. And so, as Jose said, there are many different approaches that cities have taken to promote the connection between those that are unbanked or underbanked to safe banking experiences. Some have developed products. Some have outreach campaigns. Many have versions in between. Bank On is a very popular program many of you have heard of, and other similar programs, and we can talk about some of the specifics a little bit later. But the cities have been trying to urge people and use its opportunities to connect people. Cities also frankly, touch people in need. And so our ability to not just do large-scale messaging with credible local leaders, but to also use the touch points that city agencies have in one form or another has proven very effective. The second bullet here under programs and strategies refers to the possibility that, as with some of us, we have in fact been able to develop actual financial products and work with institutions to offer those products as well. Finally, in this regard, we have been using our combined and individual voices to advocate for federal banking reform. It is one thing to urge people to use safe mainstream banking and to make that as safe as possible, but at the end of the day, maybe it's just because I'm making this phone call from D.C. today, let's face it, D.C. has the most power. So I'm going to advance the slide with my technical wizardry and talk about the second category, which is advancing financial education and counseling. Again, cities have a mandate, and we have been able to leverage that mandate in some very effective ways, not just to make sure that people have access to, quote, financial education, but to make sure that they are getting quality services and at the right junctures. So one of the things that most of the CFE cities have done is create financial education networks. The ability to pull together, in most of our cases, literally all of the local providers of free financial education and counseling services into a single network, which is then accessible through, for example, 311 call centers, vastly increases the ease with which the public can access these services. Many of us have the ability also for the public, either through a 311 operator or some of us have searchable databases online, to be able to plug in exactly what they're looking for. What's the zip code? Do you need a particular language? Is there a key audience that you're looking to target the resources to? And so this has been of great use to the providers themselves, who in addition are finding, and this is a great surprise to us, that they weren't a community before. And so in addition to a financial education network increasing access, it has also started us down the road of increasing quality as these people start to work together, share best practices, and make the most of individual mayors' trumpeting of and connecting to their services. The integration of financial education into the workplace, again, can be key. Those junctures where city governments are talking or working with the public or key partners allows us to provide scale opportunities to make sure that financial education is inserted into other places where people are getting help that they need. Just a few examples. If somebody's coming out of prison, you're talking about reentry programs. If you're talking about domestic violence programs, workforce development, on and on and on. There are so many different points of intervention, and the ability to insert financial education and counseling in a quality way at those moments is something that cities have been finding they are able to do with some success. The city communications infrastructure I mentioned, 311 is an extraordinary tool that cities can bring to the table, and some jurisdictions use their 211s. Developing standards is very key. One of the things that we like to talk about is the fact that when we are putting our mayor's name on the line in CFE activities. We do so only when we are working with quality opportunities. And so that perspective and leverage point has moved us beyond simply connecting people to what exists, but thinking about how to connect people to programs that are genuinely making a difference, to develop standards for what a financial counselor ought to have been trained in before a mayor would lend his or her name to telling people this is where you should go, or to connect those services to other programs and products. Some of us are working not just with classic education models, but with one-on-one financial coaching and counseling models, which are some real gold standard opportunities for people to sift through their problems and start moving forward. We are exploring certification in regard to the training programs as the various pilots in the CFE cities move forward. We find that we're getting real opportunity to hone what the needs are of our populations and what counselors ought to be able to provide. Moving forward on the question of asset building and protection, again, municipalities bring something unique to the table, literal power. And so whether or not we are leveraging city attorneys, whether we are literally licensing particular industries, whether we're using zoning opportunities, cities can literally affect the way key industries are interacting with those with low and moderate incomes. The example I particularly like to give in New York is that we literally license debt collectors. And so the ability to regulate those industries and how they behave, to be at the front line of what the consumer experience is and how that changes, and then to be nimble in the response is something that I think cities are uniquely qualified to do. Part of asset building in addition to protection is, of course, literally building assets. And so as we go through the list a little bit later, you'll see that many of the cities have literal and very diverse and exciting savings initiatives. Some are using public dollars, some are using private dollars, some are standalone, some are connected to other programs. And so when you combine that with various other interventions, helping people get started with their businesses or home ownership, can be really very exciting. And then again, we like to use our advocacy voice, and a lot of us are pretty vociferous about that, and that it's nice to be able to do that not only at speaking as a city, but as a coalition as well. Finally, the fourth point is the fourth strategy is promoting tax time services and benefits. Most of us are doing not just the classic outreach about the earned income tax credit, which is so vital, but also managing our city's network of VITAs, using 311 and large-scale city messaging to connect people to those services. There are also lots of interesting innovations among CFE cities, using some low-cost tax preparation models. Let's face it, VITA funding is not something we can count on forever necessarily, and so developing other models has been something that a lot of us have been paying a lot of attention to in addition to those public outreach campaigns. Tax time is also an extraordinary moment to connect people to bank accounts and savings programs, alternatives to refund anticipation loans, and CFE cities have been very aggressive about that as well. Finally, it is connecting a little bit to asset building. Tax time is a great time to be smart about leveraging savings behavior. It's the money moment, and now that the IRS has a split refund, there are lots of terrific opportunities there. On the next slide, I just want to show you a quick list of who the current member cities are. San Francisco and New York co-chair this coalition and have invited 8 other cities thus far to be a part of it. These cities are all doing really fantastic work, and we're going to go through a tiny bit of that in a moment. You see the list in front of you: Chicago, LA, Miami, Newark, Providence, San Antonio, Savannah, and Seattle. I'm delighted to say that our colleagues in at least I saw Seattle and Miami are on this call, and they're the best. At the risk of droning on, let me just tell you a couple things about New York. Andrea helpfully pointed out that New York State has a bit of asset poverty. New York City as well has its problems, as you can see. We've taken a number of different approaches. I mentioned the creation of a financial empowerment network, pulling everybody together into a searchable database or through 311. We have also created a series of, at this point, about 18 to 20 individual one-on-one counseling centers through these financial empowerment centers, where people can go in and get one-on-one opportunities to sit down with trained professional bilingual counselors and really figure out what the problem is, whether they're struggling with a debt collector, whether they're having a loan issue, budgeting, savings, the works. We are also working with our local city, University of New York, regarding a certification program that I mentioned earlier. I think it is time to start professionalizing the field of financial education, and citywide networks of educators may be one of the ways to do that. We have a New York City Safe Start account. This was just launched by Mayor Bloomberg in a State of the City a couple of weeks ago. We designed a literal account that is available to the city. Anyone can get one, and they can go to any one of the financial empowerment centers around the city to sign up. And these are no-fee accounts, no overdraft, ATM, safe banking experience for those just getting started, or for those who have had trouble and are getting back in. So we're very excited about our Safe Start account and look forward to continuing to connect it to a bunch of populations that our sister agencies are working with. Save NYC, I mentioned the savings opportunity at tax time. We're now just selling out on our third year of a matching program where if people agree at tax time to split aside a portion of their refund, and if they are successful in leaving it in this Save NYC account that we created for a year, we are matching them 50 cents on the dollar with private funds up to $500, and then encouraging them to roll it over. So we're very excited about that. Finally, and then I will take a break, we are instituting a debt consolidation loan program where we are going to be using our financial empowerment centers and our counselors to be taking some stimulus dollars and leveraging loan consolidation of loans up to $10,000. So we'll be very interested to see how successful we are at writing down the loans, and then how successful our clients are at maintaining the safe, fresh approach to their debt. Jose, I'm done.
Thank you, Jonathan. And again, thank you everyone for spending this time with us. I'd like to spend a few minutes talking about what we're doing in San Francisco. As you can see, the asset poverty rate landscape of San Francisco is quite similar to New York City's. We have launched a number of programs here. The longest, the one that we're very excited about is our Bank on San Francisco program, the first of its kind to reach out to unbanked individuals and deliver them a beneficial message that just lets them know they have the opportunity to open up bank accounts at banks and credit unions and avoid the costly check cashing services that are available throughout our city. We worked very closely with 3/4 of all the banks and credit unions in town and got them to offer appropriate low-cost or no-cost starter accounts as well as financial education to our residents here in San Francisco. We also launched the Working Families Credit, an exciting program that actually offers a cash local match to our qualified earned income tax credit applicants here in San Francisco, with the hope of increasing our take-up rate, and we've seen that work effectively and be received by over 10,000 families annually for close to 5 years now. We're doing a number of experiments around financial education. We're particularly looking at wealth care, which is a one-on-one financial coaching application, and seeing what we can do by working that through 10 community-based organizations. Very recently, we launched a healthy alternative to the standard payday loan. We partnered with 6 credit unions here in San Francisco, and they all are offering a healthier alternative payday loan, low-dollar loan, available to anyone that would probably apply for and qualify for a standard payday loan. I'll be able to receive a healthier alternative with a maximum interest rate of 18%. That's been received with a lot of excitement and fanfare, and we're very, very eager to see how that takes off, and see if we can get that program to be expanded to other financial institutions. I'd like to briefly touch base on what the other CFE cities are doing. In Chicago, they're doing a number of different programs, a lot of it around their citywide challenge to encourage budgeting and saving, as well as their initiatives in the Chicago public schools. Los Angeles has a number of efforts going on, particularly in neighborhoods through the city's community development department, which is reaching out with financial stability and wealth building training for low and moderate income families. In Miami, we're seeing exciting things happen, particularly around the area of the benefit bank, an innovative asset assessment tool that helps folks enroll in a wide range of state and federal benefits so they can benefit their families the best way possible. Newark has done a variety of programs as well, including areas around VITA programs, and most recently had an exciting launch of their Bank on Newark program to reach out to unbanked folks, where they were spotlighted in a couple of different USA Today national articles. And continuing, I believe we should be looking at, sorry, I think we missed Providence. There we go. Providence has got a strong effort going through their financial stability partnership to increase financial literacy. And then I also wanted to talk about San Antonio. Huge number of programs in San Antonio, many of them based and linked to their VITA efforts. They have a strong Office of Financial Empowerment and an exciting offering of these centers for working families, providing wraparound services and case management to transition folks out of poverty. Savannah has an exciting initiative called Step Up Savannah that's working through financial education and workforce development to help folks achieve economic independence. And then I will wrap with Seattle, who's done incredible work through their Seattle-King County Asset Building Collaborative, which has launched a number of exciting projects around EITC, free tax prep, financial education, and again, for quite some time now, a successful implementation of their Bank on Seattle-King County program. Basically, what we see going on in our coalition is that there are a number of joint initiatives and programs that we're able to really effectively roll out by being able to dialogue and communicate with each other. Our financial education initiative is actually a coordinated effort across many of the CFE cities to do what we can to improve citywide delivery systems of financial education, standardize the quality of these programs, and coordinate many of these programs on a citywide basis and offer comprehensive information to people who live in our city as to how they can access those services. We've also launched an exciting research initiative, as Andrea mentioned, with CFED, where we're looking to track our city-level municipal data and document the various initiatives that we're working on so that we can continue to offer these as examples and working models for other cities to leverage. And I think we've been very effective at combining our voices as well and doing advocacy at the federal level to protect consumers in various ways to make sure that they are being well treated by the various financial institutions and service providers out there. So with that, I think what Jonathan and I have tried to cover is both what's going on in our various cities, what we're doing to make a difference in this area and help people that live in our communities, and also talk a little bit about how our coalition, the Cities for Financial Empowerment, allows us to really learn from each other, really provide best examples and best practices in a very comprehensive and easy to implement way for each other, and also provide a platform from which to launch local as well as national initiatives in a way that makes a difference and makes these programs even more effective for our communities. Jonathan and I look forward to answering your questions, and Andrea, I want to turn it back to you and thank you for the opportunity.
Great. Thank you so much, Jose and Jonathan, for such a comprehensive presentation. And I want to thank you for your leadership of the field and also recognize the many other members of the coalition who are on this call for their work. And also, just reading through again the attendee list, the number of people from other cities around the country that are experimenting with new approaches. One of the things we hear is that the size of cities make it possible to test things that one couldn't test in much larger geographies. And so it is, just looking at the very last line, it's a wonderful platform to which to launch to local, regional, statewide, or national initiatives as we go forward. And with that, I'd like to then hand it over to hear about the state of Delaware with Mary DuPont.
Well, hello, everybody. Thank you for hanging in there and joining us on this call. I'm very excited to be here. I'm new to state government, and prior to working for the Department of Health and Social Services, which is the DHSS you see there, and the Division of State Service Centers, which is one of 12 divisions in the department. I've been in the nonprofit sector and focused on financial empowerment for, I guess, just about all of my career, which is about 30 years. So for me, this is an incredible opportunity to take a lot of the work that I was involved in the nonprofit sector, and as Jonathan was saying, to take it to scale by implementing some of these practices in the public sector. So just to give you some background, my division, the Division of State Service Centers, is one of 12 divisions in the Department of Health and Social Services in the state of Delaware. And of course, we are a very small state. We're smaller than San Francisco or New York City, but we are a state. And our division administers the community and volunteer programs for the state. Particularly, we operate 15 conveniently located centers for the delivery of public benefits and emergency services. We also administer the weatherization program, the LIHEAP program, the State Office of Volunteerism, and the Community Service Block Grant program. And they're all spelled out there, so I'm not going to go into a lot of detail on that. One of the reasons why we have an opportunity here to consider financial empowerment at the statewide level is because of our governor, Jack Markell, who was elected in 2000. I guess it was the 2008 election, took office in 2009, and prior to becoming governor, he was the state treasurer for 8 years. And in that role, he was a champion for financial literacy, the earned income tax credit, and economic justice. And as governor, his passion for this work is translated into three priorities. One is employment, economic development, streamlining state government, because along with governors throughout the country, we're facing a huge deficit, and we're looking at ways to leverage resources and promote interagency collaboration and partnerships with the private sector, and to cut back on some of the spending and the bureaucracy that is found in state government, and also to improve educational opportunities and increase access to post-secondary education. So the notion of financial empowerment is really a natural fit with our state service centers here in this division because of the work that's already being done there, which is service integration. We are a landlord for a lot of different divisions within the Department of Health and Social Services. We provide public health services, social services. All of the benefit programs are offered through our Division of Social Services, such as TANF, food stamps. We also administer emergency services for people who need help with rent bills or to avoid utility shutoffs. And so the whole notion of financial empowerment really fits right in with what we're already doing and the people that we're already seeing. We have approximately 800,000 visits per year to our state service centers to take advantage of the services that are offered there. And I also would like to give kudos to both Jonathan Mintz and Jose Cisneros, who to me have been incredible inspirations with the work that they've done and the programs that have been implemented in New York and San Francisco, which have been a model for me when I was back in the nonprofit sector, and looking forward to this opportunity to take this work to scale. So our methodology is based on the integration and the enhancement of public services. So basically, as I described, we have our public benefit one-stops, which are our state service centers, and we're also looking to partner with our Department of Labor. They have their own one-stop employment and training centers, which probably many of you are familiar with in your own states. And we're looking to try to integrate these services under one roof. So as we're helping people with their core benefits service programs, we're also going to be able to refer them to workforce development programs. And then what we'd like to do is layer on top of that financial empowerment services, which I'll describe in the next slide, so that the concept is bringing together all of these services under one roof. And the way that we want to approach this is through public-private partnerships. Right now, we're working very closely with the United Way of Delaware through their Financial Stability Partnership, and we're also working with a lot of other nonprofit organizations, because with the goal of making sure that we are streamlining state government, we're really not looking to spend more money to do this. We're looking to spend less. So these partnerships are going to be critical to make this happen. So the model that we're putting together at the moment, and I've been here less than a year, and so it's taking some time, but actually I'm happy to say that we're getting ready to launch a pilot in one of our state service centers. And the model includes, for the financial service package, financial coaching. We've partnered with the University of Delaware and the New Mexico Foundation to develop a financial coaching training, and it'll help our clients on a one-to-one basis. And we're looking at serving not only the existing clients that are already coming into the state service centers and for benefits and for workforce development, but we're also looking to serve a new clientele who may be going through some type of a life transition and could benefit from a one-on-one conversation with somebody who can help them with budgeting, financial planning, managing credit, or any issues that they want to discuss on their finances. We're also looking at including free tax preparation. Prior to being in this position, I ran the state's Earned Income Tax Credit campaign, so we're looking at partnering with the Nehemiah Gateway Community Development Corporation that runs the campaign, and we're also looking to incorporate an array of self-help methods where people can come in and do their own taxes. So for this year, we're going to get started with the self-help, and hopefully by next year, we'll also be integrating the VITA services that are available through the campaign. Obviously, no tax campaign is complete without a financial service component, as Jonathan and Jose were referencing, to provide taxpayers an opportunity to save some of their refund. So, but we're looking to also expand this year-round to make financial services available and provide our customers with an opportunity to open up savings accounts, to save money, to clean up their credit. There are also some innovative programs in the nonprofit sector here that address payday lending, or provide alternatives, I should say. So we're really looking to incorporate the best practices of what's already going on and then enhance that throughout our system. And then finally, we're looking at incorporating a college-bound program, which is basically built on these other components that would include financial planning to assist a family who has a child who is headed towards college, and to help them to figure out a plan for how to pay for this, and also help with filling out college applications and with the financial aid, with FAFSA applications. So our goals are really a culture change at the state level that would basically address increasing the interagency and the private sector partnerships, our clients, helping them to transition from benefit dependence to economic independence, and our frontline staff, who will all be trained in financial coaching, to help them to transition their relationships with the clients from being reactive to emergencies that our clients present, to being more proactive and coaching and supportive around financial issues. And again, as I already said, we're anticipating there will also be a new customer base who we haven't seen before, people going through life transitions, working poor, victims of the economy. We're looking to expand access to personal financial advising, post-secondary education, and financial services. I'm particularly intrigued about the financial coaching strategies. We have a very robust financial education network already in Delaware. It's called the Delaware Money School, and we offer hundreds of free workshops throughout the state. And I'm particularly interested to see how, what kind of an impact we're going to be able to have by working one-on-one, offering financial coaching versus the financial education, or I would say in addition to financial education. We're looking to increase personal confidence in money management and goal setting and goal achievement for our customers, and to complement the safety net programs with personal empowerment strategies around money management, workforce development, and post-secondary education. So where we are right now, as I said, we've been developing a lot of partnerships. We're working with a lot of the nonprofit sector. We're looking for ways to support these initiatives through these partnerships, and also through volunteers that we plan to recruit and train. We're also going to be hiring we are bringing on a site coordinator to launch our first location. And this person is already on board, and I believe is attending this webinar, and Miriam Travers. And we are also working with the University of Delaware and other advocates in education to develop the strategy for the college-bound program. And our governor, we have met with the governor. He is very enthusiastic and on board with this. And we're also looking forward to our partnership with CFED on innovation to get this up and running, not only in our pilot site, but throughout the state, and to learn all that we can from the innovation partners who are already on board, and to continue to work with Jonathan and Jose and all of the other financial empowerment cities. So I'd like to thank Jim Cooney and Andrea Levere for helping us to get to this place.
Thank you, Marion. Thank you for your quite amazing work and the directions you're going to in Delaware, which, as you remind us, is smaller than several cities. What I also wanted to encourage you is we have some outstanding questions already lined up for after our next presentation. So please, as the Spirit moves you, put your question in the Q&A area. And with that, I'd like to introduce my colleague, Carol Wayman, Director of Federal Policy, to share her perspective on federal policy opportunities.
Thank you, Andrea, and thank you, Jim, for hosting this event today. It's always such a thrill to follow some really amazing examples at the city and state level. And everybody on the phone, on the webinar, can really see that this is a time like no other for asset policy in a generation. What I want to do is link Andrea's presentation of the scope of the problem of asset poverty to the solutions, because right now we have an opportunity that we haven't had in years to have solutions at scale. So President Obama has embraced savings and wealth building for low-income and moderate-income people as a core component to his economic policy. He's talked about moving from a borrow and spend economy to a save and invest economy, and this breaks out for the folks that we work with at CFDD on the micro level for building up a financial cushion, making sure families have a down payment, college savings, and money for retirement, all the way up to the macro level, that in a global economy that we have more money locally for savings and investing without having to borrow. So in the interest of time, I'm going to just talk about a few of President Obama's recommendations for new laws, and then some other things that congressional leaders and champions are proposing. So the first one, President Obama did a major address on savings policy, and he called for a number of executive orders, which are moving, and 3 new laws. One is called the automatic enrollment, and what automatic enrollment does is require, it would be a new law that would require employers who do not currently offer a retirement plan that they would have to enroll their employees into an IRA, individual retirement account. And this gets to the problem of lack of access, that over half of the workforce, 78 million people, do not have access to an employer-sponsored retirement plan. And if you think of how people are building wealth, they are doing it through their employer. And without that access, they're much less likely to go out and find an IRA, choose one, and start making donations to it to build up their wealth. And we're looking at Mr. Bingaman from New Mexico and Congressman Neal from Massachusetts to lead this effort to promote automatic enrollment into IRAs, building off the success that we're already having with employers who do offer plans through automatic enrollment. We find with inertia being as powerful as it is, that folks have especially hard times with saying, I'm going to join a plan, I'm going to fill out this paperwork, I'm going to decide what plan, decide how much, and actually turn in the paperwork. And when you're trying to move the needle on asset poverty the way that we are in these critical populations, young people, low-income families, African Americans, Latinos, renters, automatic enrollment has been very successful. Moving on is the Savers Credit. The Savers Credit builds on the infrastructure by also providing an incentive. This has been introduced by Congressman Pomeroy. I know Andrea is on the phone Andrea Olson from North Dakota has done a great job at educating the congressman on this issue. It's also going to be introduced, we hope, by Chairman Baucus from Montana. And what this would do is provide a match for families who save into an account. So if you save into a retirement account, you currently get a match, but it's rather complicated and it's not refundable. So it's not reaching low-income families. So what this change would do is a 50% match on $500 of savings for an individual or $1,000 for a couple. And then a real amazing innovation would be to deposit the match directly into the account. And this is the split refund form that was talked about earlier, IRS Form 8888, where you can direct some of your income tax refund or funds directly into one of these accounts. So we're building the infrastructure of having people have accounts and building the adequacy so that they have actual more money in savings. The third thing that's been talked about is, from President Obama's perspective, is asset limits. This has been very troubling when we're trying to work with low-income families to save money, and that there exist in policy penalties for savings. So if you have more than $2,000 or $3,000 in a 529 or a retirement account and you needed some short-term help, in most states you have to spend that down, pay penalties. And so there's been talk about removing asset limits from TANF and increasing those limits in the Supplemental Security Program, SSI, both of which, these $2,000 levels, they were set in the mid-'80s, so they're really out of date. Another really wonderful opportunity that's happening just this year, brand new, is allowing people to buy savings bonds on their tax returns. So the Cities for Financial Empowerment and Mary, who preceded me earlier, this is a great opportunity to promote savings bonds as a gateway product. We're also working on expanding individual development accounts, match savings accounts through a tax credit, and accounts at birth for every child. And finally, we're looking at full file reporting, providing affirmative permission for utility and telecom companies to report to credit reporting agencies people's on-time payment, not just their late payment. And all this information is available at cfed.org/policy. We have one-pagers on all of these issues. You can see how many co-sponsors on various bills we have. And in closing, I just say that what we're at the precipice, at the cusp of building right now, is building a consistent, duplicative infrastructure of accounts at birth, accounts, time to save when you're working with a nonprofit or getting social services, time to save when you're filing your taxes, time to save when working with an employer, and then having matches to ensure adequacy. And we're very hopeful that our vehicle for all of this will be this year's tax bill. Andrea?
Thank you, Carol. That was wonderful. Short and sweet. I'm extremely pleased to be able to say that all of our panelists have agreed to stay until 5:15. So we are going to spend as much time as we can on questions, and thank all of you who've given us questions so far, and we're going to jump right in. And let me begin just with a question. How can the programs of larger cities work in smaller cities, that is, with populations of less than 100,000, where the impact on poverty has a proportionately larger impact on the community, but there are fewer resources for us to work with as well? So I'm going to send that over to either Jose or Jonathan or both of you to give your idea about that.
Hi. I'll take a crack at it, Jose. You can say if I miss anything. This is Jonathan. I really appreciate the question for a couple of reasons. One is I think that the question of money is significant. It always comes up. And I would emphasize that many of the programs that you saw briefly outlined from the CFE cities are either privately funded or are not particularly expensive, quite frankly. There are very strategic ways to use city opportunities that don't have to cost a lot of money. Our banking initiative, for example, in New York, as one example, it really doesn't cost anything. Regulatory approaches as well, not expensive. In fact, frankly, you can sometimes pull revenues from the violations that you end up writing. So you should definitely not take a look at the work of larger cities and assume that that's about spending large amounts of money at all. I would also say when it comes to funding that, because cities are hitting scale, it's of real interest to the philanthropic community. And I know that Mary has found the same to be true, I think, in Delaware. So I would be ambitious about the idea and worry about funding second. But real quickly, I also just want to add, For all the details on all of those programs, anyone who wants to go to www.cfecoalition.org, you can scroll through all of the links to all of the city's programs and get much more information.
Yeah, and Jonathan, in addition to that, it's Jose here. I would just mention quickly that the city of Evansville, Indiana, population about 121,000, last year launched a Bank on Evansville program. And again, like Jonathan mentioned, it didn't cost a lot of money. It took a little bit of resources, but and basically they followed the model of many other cities and what we did here in San Francisco, and they were able to launch a successful program.
Great. I want to pose another question, part one of questioners, which is how were the cities that are part of CFE selected, and is there an opportunity for the group to be expanded?
Yeah, this is Jose. I'll talk about that. We actually have grown the group of cities. The CFE Coalition started with 6 cities, and basically the way the cities were selected and will continue to be selected is by evidence and the reality of what's going on in those cities. What we really wanted to do was bring together a group of cities that were true practitioners, cities that were actually implementing one or more of these financial empowerment programs, because we wanted to be able to talk the same language to each other, share best practices with each other, and continue our momentum going forward. As we see more and more cities across the country rolling out more of those types of programs, we fully expect the coalition to grow. So we would again encourage anybody to contact Jonathan or myself or reach out through our website and let us know what you're doing in your city. We look forward to adding more cities as we go along. I would also mention that other groups like the National League of Cities has partnered very effectively with us and put together joint sessions where we actually reached out and shared many of our best practices and our examples with all cities from all across the country who were just beginning to look at this type of work or further down the road. And I think there's also a lot of great contacts at groups like the National League of Cities that can help other cities come up to speed, really roll out some really effective programs, as well as get them introduced to those of us in the coalition.
Okay. Now I'm going to ask a profound and provocative question to Carol, which is, wouldn't a strategy of addressing the national policies that have been implemented over the past 35 years that have led to the current concentration of wealth to an increasingly small percentage of Americans be more effective than nibbling around the edges of causes and solutions to poverty?
Okay, volume 1 of answering that question. That is a great question, and you're absolutely right. CFED has a publication called Return on Investments, getting more from federal asset building policies that you can get from our website, and we actually lay out how asset subsidies are distributed throughout the income quintiles. And you're absolutely right that 45% of about $367 billion of subsidy goes to the top 1% of households. So those are households earning over $1.25 million. They get a great deal of subsidies in mortgage interest deduction, capital gains, retirement savings, property tax deduction, 529 appreciation, estate tax, lots of different things that actually is disproportionate to the amount that they're paying in taxes. So if you're getting about a 45% penalty or 45% benefit, your taxes are roughly around 22% of the total. So it's really kind of an upside down subsidy. I think President Obama has recognized this, and one of the things that he has included in his budget is capping deductions at 28%, which is something CFED has proposed and supported. And I think for those of you on the call, I think this is the time to talk to legislators about this issue, because a lot of these issues, when they come up about touching deductions, touching that other side of the budget, we talk a lot about appropriations, but when you talk about touching entitlements, the phrase you get here in Washington is the third rail. Don't touch the third rail. And so it has to build a groundswell of support for things that are progressive, that really reach the folks who need the incentive to save and are not just subsidizing savings, just move from general savings to tax-deferred savings.
And if I could add to that, I think the other power of this question is just that the whole policy of asset limits has probably done much more harm than good in any way, shape, or form. And what we've discovered in the 2 states in the United States where they've eliminated all asset limits is the great fear that there'd be a rush of people who would come to claim that public benefits has been completely unrealized. And alternatively, the people who were deployed to check people's assets now are redeployed to much higher and better uses, and everybody benefits in that state. A more specific question for Jonathan and Jose, which is, do you have a relationship with CEOs for cities or another national network that you feel add power to your work? Not sure if CEOs for cities gets down to the trenches, but could be wrong.
This is Jonathan. You know, we couldn't do all of this without partnerships, CFED being obviously one of them. And, you know, we work with the National League of Cities and a number of key other research institutions and funders and all of that. I do think that one of the values of working out of a city hall is the ability to make those high-level connections, the ability in most of our cases to literally be able to call CEOs of some large employers and figure out how to engage them, whether you're engaging them to push a product or an opportunity, to secure volunteering opportunities, philanthropic approaches. It is one of the ways in which we are able to use our mayor's commitments to these issues.
Another excellent question. I've noticed that several cities in your presentation are involved in Bank On. Is that a national initiative, or are individual cities promoting this on their own? And how can Milwaukee be involved?
This is Jose. That's a great question. It's a question we get constantly here in San Francisco. Ever since we launched the first Bank On program here with our Bank On San Francisco program, now well over 3 years ago, other cities have approached us and asked about this exciting program and asked how they could roll it out in their cities. We have worked in partnership, as I mentioned before, with the National League of Cities, and folks there have been helping cities across the country launch their own Bank On program, so they can have a Bank On Seattle or a Bank On Newark or a Bank On Houston or a program of their own in their city. And in fact, as of now, there are somewhere between 60 and 70 cities across the country that are in one stage or another of rolling out their own Bank On Their City program. So it really has spread completely on its own in a rather viral way. What we in San Francisco have done to support that is we've actually put together an online portal, a website that anybody can go to across the country, and they can use information there to figure out how to start the discussion of a similar program in their location. Be happy to share that website. It's called, it is www.joinbankon.org. That's joinbankon.org. And there you will see all sorts of resources, primarily from the cities that have launched programs already, so from San Francisco, Seattle, Newark, and many, many, many others. Resources about how we developed our programs, what kind of trainings we did with financial institutions, with community groups, what kind of outreach we did, marketing materials we used, on and on and on. And it really gives, I think, the next cities that want to look at this program a true leg up and an opportunity to learn and in the best way possible from our examples and from our successes and perhaps from some of our mistakes, so they can avoid those. But I think what they'll see there is that it's a really exciting program. It's an easy one to put together, particularly with the guidance of the previous cities that have done it. And as such, I know that there are some folks at the federal level that are looking at what the federal government might be able to do to promote this program and programs like it across the country to encourage more and more cities to do this kind of financial empowerment work. So again, I encourage everyone to look at both the CFEcoalition.org website and the joinbankon.org website, where they'll see a lot of great resources, a lot of good examples, as well as contact information, and we're happy to continue to engage. We here in San Francisco, and I'm sure the same goes for New York, we're happy to engage with any cities individually to answer any questions or provide any help we can.
Great. Thank you so much, Jose. A very quick question was, which states have eliminated asset limits completely? The two states are Virginia and Ohio, and there's several other states that have eliminated significant asset limits in particular programs, such as TANF or Medicaid. And all of that is up on CFPB's website for the scorecard. And you can go, because eliminating asset limits is one of our 12 policy priorities. You go up on the website, and you can hit right on that policy, and you can look at every single state and discover exactly what their status is and what we recommend they should do on asset limits. We've created criteria which give states particular points on those asset limits. And I also want to thank many of our loyal listeners for also adding the Bank On link into the questions. A different question, which was, how does the President's Fund for Social Innovation figure into supporting these exemplary, thank you very much, efforts? Are you, an umbrella organization, able to apply for such funds? So here we go, which is, we don't quite know yet. Many of you may have done what CFED has done, which was respond to a request for comments on the initial RFQ of the Social Innovation Fund, which will be part of the Corporation for National Service at the national level. This is a $50 million allocation, which is not much given the level of marketing the Social Innovation Fund has. I think everybody on the planet Earth and several other planets know about it at the current moment. So we don't have the final rules or regulations. What I do know about the program is that it is focused on intermediaries who then can raise significant amount of money to re-grant on. I will tell you that CFED is actively looking at how we can support the broader field through this. And I know virtually every other organization that I talk to is trying to do the same. So probably the most important part about this is that this signals and gives credibility to these efforts at the national level in a way that also helps in fundraising in the corporate and philanthropic communities, which I think is key. So thank you very much for that question. Let's go on to some other questions, which is one, a very interesting question, which is, how do I respond to arguments that everyone needs to save even when they have outstanding credit balances? Mary, I would love you to take a shot at this, because this is something I think you've dealt with on a day-to-day basis for years.
Well, what we've done over the years, let's say what in my past experience running an earned income tax credit campaign, was to take advantage of the big refunds that a lot of people get at tax time. And I don't remember who was referencing the savings bonds, but savings bonds are a product that a lot of people are familiar with, and the Form 8888, which is the strategy that's been implemented for several years now by the IRS to split the refund into as many as 3 direct deposits, is a way to enable somebody who's on a very low income, who has a lot of debt, to begin to put a toe in the water. And the way that I've always looked at it is, it's not going to solve all of the problems, but a lot of, I think the issues about savings are just getting started, and just putting aside that first $50, $100, beginning a practice, changing mindset. So I don't think that savings is necessarily always going to solve all of the financial problems of a household, but I do think it's an important habit for every household to engage in, just like, healthy diet and exercise and all the things that we have to do to keep ourselves healthy and alive. I think to be financially healthy, people need to be aware of their credit, need to at least have a look at it and begin a strategy to address it, as well as to be aware of the opportunities that are out there to save and take advantage of those moments when there's some money that they can invest in a savings bond, a CD, a savings account is not really an investment, but
this is Jonathan. I just want to add something real quickly. Mary's work has been so great on this. Two things. One, whenever I talk about it in New York, I always take the perspective that people should never wait for their present tense to be cured before they start thinking about the future. That moment really never comes, and so I think it's a false argument. Second, I would throw some data at the group, which is, we've done this program like what Mary described, called our Save NYC program, where we have encouraged savings at tax time, and we just released some data on that, which is startling. The average, 75% of the people who tried to save money over the course of the year succeeded, and their average income in New York City in the middle of financial hell was $15,500. So the truth is, people can do it, and they will do it if they're given the right opportunity. And I think data like that can go a long way toward busting the myth that, now's not the right time, people with low incomes aren't in the right spot. I think those are all nonsense.
Jonathan, are you finished?
Yep.
Okay, great. There was a question before, which was a great question in terms of social networking around people who are interested in asset building or as part of CFE. And I want to open that up to everyone, and then I will finish up with some thoughts as well. Mary, any experience you have with social networking as a tool to help advance your goals?
Well, there's the community development listserv, and I've been on it for so long I don't remember how I got on it. There are a lot of listservs. There's the tax roundtable for people who are involved in the free tax preparation field, which also covers a lot of the issues about financial services and financial products. And those are the two that I've been actively involved in. I don't know about Jonathan and Jose and others.
Hey, Andrea, this is Jose. I would just follow up on my comments on the joinbank.org website. There is a series of discussion sites, pages on that site. So there is actually a social networking perspective to that Joint Bank on site. For example, in addition to just having a dialogue amongst people from across the country about various issues and how they might affect that type of a program, there's actually an opportunity for people in a city to identify themselves and say, hey, I'd like to reach out to anybody here locally in my city to see if anybody else has an interest, an opportunity, a resource that they can bring to launching this same program here locally in the city that they're looking at doing it in. So there absolutely is a social networking function built into the joinbank.org site.
Great, thank you. Let me also say that at CFED's website, at Innovation at CFED, we have a social networking capacity to link people particularly focused on innovation. And we are also investors in a new website called SaveTogether.org, which is a website that allows individuals to match the savings of low-income people in amounts as little as $1. It's modeled very much, as you probably know, off Kiva.org, but it is a wonderful resource. And then I want to say that at the Asset Learning Conference in September, we're going to have a mini track on all aspects of municipal financial empowerment and asset innovation to really help share practices. I have another outstanding question which relates directly to the current economic and financial environment, which asks the question, given what's happened recently to our financial system, how do we make sure that the investment vehicles that we're encouraging everyone to either buy into or save into are secure? And I think everybody might have an answer to that question. Who would like to jump in first?
This is Carol. I could start with on the savings bonds. One of the really good things about the savings bonds is that they're inflation protected I bonds, so that they're always, you're definitely going to do better than inflation. It's currently at about 3.36%, and that changes every 6 months, so it's a really very good investment. And as far as retirement and other types of products that we have looked at, in talking to folks about these products, is looking over the time period that people will be using them and giving them the types of disclosure and other information that they'll need to understand what kind of investments they're making. One of the phrases that we've heard before is it's better to have 80% of something than 0% of nothing, and not to get so terrified that you might lose money in an investment account, but they're going to gain over a period of time, but making sure people are making safe investments. And I think the Department of Labor and Treasury have been really very helpful in this, in putting together plans of life cycle funds and the types of funds that people are opted into that are more secure than just encouraging people to just pick something randomly.
Who else would like to jump in to answer that question?
Yeah, this is Jose. What I would say basically is, I think that's a really good question. But I think Carol's answer about the various diversity of opportunities for investments is boundless, and it ranges from extremely safe opportunities like saving bonds or financially insured bank deposits and time deposits and things like that with FDIC insurance, to even other things. And I think what this comes down to is a matter of financial education. People are best served by better understanding the opportunities out there, and then they can make the right choices for them and for their families. And it really is only with that education that they're going to be able to hopefully weather the difficulties we've seen of late.
This is Jonathan. I would just also quickly add that in those approaches that involve the literal negotiating and creating and branding of an account, that's obviously part of what you negotiate. So that you can literally ensure what people's terms are.
Great, thank you very much. Mary, where can we subscribe to the Community Development Listserv?
Like I said, I've been on it for so long, I don't remember how I subscribe, but what I will do is Jim, would I be able to get you that information so you could post it on the website?
Absolutely, and I can add, there's a couple other, you guys are so great covering all these resources, and I know I don't have all of them on our resources page, but I will work with you guys offline after the event to try to add everything that you guys have talked about.
And we have an eager person who wants to sign up for the Asset Learning Conference right now, and I wish I could say yes, but it's not until April. But we will also put that link up on this website, and as well as anybody can go to CFED's website and sign up for a host of different services and our mailing list, as well as to receive policy alerts in terms of state asset policy, children's savings policy, and federal policy, if you want. I'm going to direct a question now to CFED's research director, who is sitting with me, which was another question about, is there a clearinghouse that provides information on evaluation models for this work? So I'm going to introduce Ida Rademacher to answer that question and then open it up to any of the other panelists.
Putting onto our Knowledge Center. part of the funding that we receive from certain have cataloged a set of kind of market research and also with the scorecard, although the level of evaluation happening at the state, not as much.
Sorry, I was just told that I couldn't be heard, so I'm going to just say quickly again that that there isn't right now one clearinghouse, but part of the work that we were funded to do with Cities for Financial Empowerment is that work will be included in the report that we're putting out in the spring on municipal assets, policies, and programs, and the research track at the Assets Learning Conference will have a whole host of a range of the evaluations that are going on. So I'm not sure if people can hear me. I'm going to stop right there.
Yeah, your second, Ida, your second attempt was heard fine. So thank you for repeating.
We had another question asking where they could find information on the study that Carol cited, which was return on investment. We will also list that on the resources page, but you can go right on CFED's website and look up that study. And in addition, we are updating that within the next several weeks, and what we're very excited about is also for the first time thinking about affirmative policies that can begin to change this kind of allocation. So we are looking forward to that as well.
And I can just bust in and mention it's the Community Development Banking listserv that Mary talked about is Community Development Banking, all one word, -L at cornell.edu.
Thank you.
And as one alert reader, as my favorite Dave Barry line says, the Social Innovation Fund is now accepting applications online, which is very surprising to me, but I will go check it out immediately, and we'll put that up online as well. So thank you very much for that information. Mary, I interrupted you. Go right ahead.
No, I just said great. Thank you for that.
So we are now at the end of our questions. And I just want to thank everybody. We've had an extraordinary group hanging in there with us for almost 2 hours. I want to thank all of our speakers and mostly thank all of you who've been listening for the extraordinary work you do on behalf of advancing this field. And I'd like to hand it back to Jim Cooney to close this up.
Thank you, Andrea. Thanks again to our presenters for being so composed and gracious about our late start. You guys were great, and thanks to our audience members for working through that first 15, 20 minutes. I will just reiterate that in addition to posting the recording of the event and presenters' slides pending their permission, I will also be working with them to add additional resources to our resources page, as there were many, many, many websites and articles discussed that would be great additions to that. So I'm going to try to collect links to all of those and add them as well. And I'll be in touch with all of you via email in about 2 to 3 business days, and alerting you to where you can find the recording, the additional resources, and the slides. And that's about it. Thanks, everyone, for your attendance and participation.
Thank you, Jim.
Okay, thank you.